Welcome to the third chapter of this masterclass on integrating risk and finance in association with SAP. My name is Brian Caplen, editor of The Banker, and to discuss this topic I'm joined by Rieker, who is SAP's Global Head of Banking, and Mike Russo, who is Senior Financial Services Solutions Principal. And in this chapter we're going to look at addressing risk and financial management in real time. So welcome, gentlemen. Falk, if I can come to you first. If you want to address something in real time, you've got to have the right architecture to do it, haven't you? So where are banks standing in that respect?
I think that's the first challenge they have. So, real time is an aspiration, I would say. Reality looks different. Due to the different technologies in place, due to the different capabilities of the system, due to the heterogeneous landscapes, real time is hard to achieve. I would call it near time at best, even on the risk side. On the financial accounting side, in many cases, we see batch processes at this point in time.
Okay, but there's also a bit of a mismatch here, isn't it? Because when you think about the stress testing that the banks are being asked to do, I mean, that's a kind of sort of very slow, sort of almost prehistoric process, and at the same time we're asking them to do it in real time. I mean, is there a bit of a disconnect there?
It's a good point. It might be a real-time analysis, but not necessarily on real-time data.
Yeah, and by the time you finish your stress testing, you're almost ready to do another one.
Exactly.
Yeah. So, Mike, I mean, what do you think the drivers are for getting the banks to do this real-time reporting?
Yeah, I mean, I think to a significant extent, it's really tied up with performance management. I think in the current regulatory environment, right, where the cost of capital is higher, the cost of holding liquidity is higher. I think it's important for banks, to be able to understand very dynamically and before the next transaction is done, so to speak, what the impact is going to be based on the particular transaction that they're doing. So if they understand before the transaction takes place, how it's going to impact their capital position and how it's going to impact their liquidity position, they can, for example, price it appropriately. Because at the end of the day, what the banks are after are higher risk-adjusted, is better risk-adjusted performance. And really the way you get to that is really, understanding, more dynamically what the impacts are going to be, before you do the next transaction.
Okay, but these are the drivers for the banks. But the regulator has quite a different perspective, don't they? So they're really looking at resolution and could I, take this bank apart and put it with another bank if it got into trouble?
Yeah, no, exactly. So if you think of the BCBS 239, the risk data aggregation, I think coming out of the financial crisis, when banks were getting in trouble and, the regulators were asking banks, what's your exposure, across all your geographies, across all your legal entities, across all the activities you do with a particular counterparty. And in many instances, it was taking weeks, for banks to return the answer to that question. So I think, regulators, are wanting to understand, very quickly, what the impact is going to be, in a crisis situation. So, as you mentioned, things like resolution can be dealt with, more effectively. So I think that's the big driver from the regulatory perspective, getting a handle on what the situation is during a crisis so that they can, proactively determine the best approach to resolve a bank.
Okay. So, Falk, I mean, really the sweet spot would be, wouldn't it, if you could actually put this together to satisfy the regulators and get some performance benefits out of it at the same time. I mean, do you think that's achievable for the banks?
I believe it is, yeah. And let's stick to BCBS 239, yeah. For the first time, yeah.
And this is from the Basel Committee, isn't it?
Correct.
And this is their thing on aggregating data.
Yeah, risk aggregation. So for the first time, this is not just about methods and calculations. It's about data architecture and IT technology as well. So they are looking at not only if the calculation is right, but looking at your data architecture, how you manage data, which technology you use. So, and I think that's the right approach, yeah? All of a sudden you have a holistic approach to the problem. You're not just looking at the results, you're looking at the source of the problem, yeah?
Okay, but I mean, this is night and day, isn't it, from where we were before the financial crisis in terms of the regulators' involvement in all aspects of banking?
Yes, and I think it's all to the better of banking. It raises the awareness in the banks, how they manage their business. So they are connecting these reports that are done for regulatory purpose, all the stress tests like CCAR, with their actual business they are doing on a daily basis. So in the past there was always the internal reporting and the external reporting, and now we are more and more seeing that both dimensions are converging.
Okay, gentlemen, let's leave it there. Let's come back and talk about bank performance in just a minute.